Hello, everybody. Greeting to all friends, especially to our respected lecturer, Miss Munira Muhammad. Allow me to introduce about myself. My name is ELIX now Felicitom. Today, me and my team would like to present about our presentation topic is differentiate between the concept of insurance and insurance in Islam bracket takaful. In our presentation, it's cover the content. It's include first introduction, the second the definition, the third history, the fourth is general concept of insurance and concept in Islam, fifth example, and the sixth about the lastly about the conclusion. Introductions. Insurance hold a crucial role in the framework of contemporary financial system. It is fundamentally a system designed to reduce uncertainty and safeguard against the financial repercussions of unexpected occurrences such as accidents, illness, natural catastrophes, or death. Insurance serves as both a private safety and a stabilizing mechanism for the broader economy by facilitating the transfer of risks from people and business to specialized organizations. Academics like Reza Ronaldo assert that insurance operates as a financial umbrella, essential for protecting societies from life unanticipated challenge. Nevertheless, despite its acknowledged economic and social benefits, traditional insurance remain continuous when analyzed through the perspective of Islamic jurisprudence. Classical Islamic jurisprudence forbids contractual agreements that involve riba interest, gharar, extreme uncertainty, and maisir, gambling. All three components are integrated to differing extent inside traditional insurance. Premium payments are allocated to interest-bearing instruments resulting in exposure to riba. The disparity between premium paid and benefits received creates gharar, as one insured individual may contribute for years without receiving any benefits, while another may contribute minimally yet receiving disproportionately huge payout. Definition. Insurance is a legal economic mechanism intended to alleviate uncertainty through the transfer or sharing of risks. Legally, it is characterized as a contract in which one party, the insurer, agrees in exchange for a premium to compensate another party, the insured, for loss, damage, or liability resulting from uncertain event. The economic perspective characterizes insurance as a financial intermediary premium gathered from policyholders are allocated into investment fund, facilitating capital formation, infrastructure developments, and long-term economic stability. Insurance is frequently characterized as a safety net, facilitating recovery from disaster and ensuring the continuity of livelihood for individuals and enterprise. Insurance is differentiated from gambling or speculative activities by its fundamental objective. It does not generate new hazard but reallocates existing risks in a legally binding and socially beneficial way. Different aspect of the definition of insurance. First, legal aspect. In Malaysia, insurance is legally classified as a contract of indemnification enforceable under statutory and common law. The basis of insurance regulation is established in the Financial Service Act 2013, Act 758 for conventional insurance, and the Islamic Financial Service Act 2013, Act 759 for takaful, both of which replaced the Insurance Act 1996 Act 553 and the Takaful Act 1984. Second, economic aspect. Economic aspect. Insurance is economically defined as a financial tool for the transfer of risk. Insurers aggregates risk by collecting premiums from numerous policyholders, so establishing financial reserve to indemnify those who incur losses. The third, actuarial or technical aspect. Insurance constitutes a systematic process of risk aggregation and probability utilization. It depends on the law of large numbers to forecast losses within a cohort and allocates them fairly. Different aspect of the definition of insurance. The fourth aspect is functional aspect. Insurance is classed based on the kind of risk. It encompasses the most comprehensive classification, differentiate among life insurance, covering human life, health, and pensions. General insurance include fire, marine, motor, and liability. And social insurance, government mandate program such as workers' compensations. Each category modifies the fundamental principle of insurance to meet particular requirement and circumstance. The fifth aspect is a social aspect. Insurance additionally has a societal functions. It serves as a safeguard, providing stability for individuals and families while fostering resilience in areas impacted by disaster. In Malaysia, the insurance sector has been crucial in post-disaster reconstruction and ensuring business continuity. Reza Ronaldo's characterization of insurance as a financial umbrella highlights its extensive role in social safety and psychological assurance. I want to present about the history. The evolution of Malaysia insurance industry mirror the overall progressions of the nation financial sectors, transitioning from colonial institutions to a dual framework of conventional and Islamic takaful insurance governed by contemporary legislation. The history of insurance in Malaysia illustrates the progressions of the country's financial and legal systems from colonial impact to a dual structure of conventional and Islamic insurance. The origin of insurance in the country may be traced back to the British colonial era, during which foreign firms headquartered in London and Singapore monopolized the industry. Initial insurance offering, including maritime, fire, and life insurance, were designed for expatriates, plantation proprietor, and merchant, with restricted local involvement and negligible regulatory supervisions. For decades, Malaysians had little access to advanced coverage, and the sector was predominantly foreign controlled. The enactment of the Insurance Act 1963 marked a pivotal advancement, establishing the inaugural comprehensive legislative framework for the licensing and oversight of insurers in Malaysia. This statute established the basis for insurance as a regulated contractual entity. However, the mark remained influenced by foreign participants and comparatively low local penetration rate. Bank Negara, Malaysia, 1988. Now for the next slide, I give to my colleague Dia Sofia to continue the presentation of this topic. Thank you.
My name is Dia Sofia, and I will be presenting about the history of insurance. Continuing from ELIX, the early development and colonial legacy, which is pre 1957. Insurance in Malaysia began during the British colonial era, dominated by foreign firms from London and Singapore. Their offerings focus on maritime, fire, and life insurance for expatriates, traders, and plantation owners, with minimal local participation and regulation. Malaysians had very limited access to coverage. A major milestone came with the Insurance Act of 1963, which created the first legal framework for licensing and regulating insurers, setting clear standards for solvency and operations. Moving on to the next slide, which will be the post-independence development. It will be from 1957 to the 1987s. After independence in 1957, Malaysia began strengthening and localizing its insurance industry. By the 1970s, insurance was recognized as a tool for economic growth and social protection. Though foreign firms still dominated, the Ministry of Finance took the change of licensing and compliance, while both life and general insurance sectors expanded. However, insurance penetration remained very low compared to developed countries. To the next slide, which shows the expansion and reform from the 1988s to the year of 2010s. In 1988, insurance oversight shifted from the Ministry of Finance to Bank Negara Malaysia, which is the BNM, which strengthened solvency standards, regulation, and professionalism. This drove rapid growth, with coverage rising from 11.4% to 31% by 1999, and industry capitalization expanding nearly fivefold. The Insurance Act 1996 further safeguarded policyholders and regulated insurers. From the 1990s to early year of 2000s, insurance and takaful assets grew at 13.3% annually, from 52 billion ringgit to in the year of 2000 to 181 billion ringgit in 2010. Life insurance became the main growth driver, while the sector also supported national development through investments in bonds, infrastructures, and capital markets. Industry consolidation reduced smaller players, strengthening resilience and positioning insurance as a vital part of Malaysia's financial system. To the next slide, which will be the rise of Islamic insurance, which is known as takaful from the 1982 to the present. Malaysia introduced takaful in 1982 as a Sharia-compliant alternative to conventional insurance. The Takaful Act 1984 led to the creation of Syarikat Takaful Malaysia Berhad, the first operator ensuring compliance with Islamic principles by avoiding riba, gharar, and masir. Over the following decades, the sector grew with entry of new players like Takaful National 1993, Takaful Ikhlas the year of 2003, and Prudential BSN Takaful in the year of 2006. And the next slide, which will be the contemporary developments and challenges from the year 2010 to the present. In recent years, Malaysia insurance industry has undergone major reforms, including the shift to risk-based pricing in 2017, which improved competition and efficiency. Although the goal of 75% penetration by 2020 was not achieved, liberalization enhanced transparency and product variety. The sector also accelerated digitalization during COVID-19, adopting online services and health-focused solutions, while climate change and extreme weather have become pressing challenges. This is the last slide for me, which will be the general concept of insurance and concept in Islam. So for conventional insurance, it is a traditional insurance operates as a legal and financial instruments for risk transmission. Individuals or entities pay premiums to an insurance which bears responsibility for designated risks such as mortality, accidents, or property damage. For Takaful, it is based on risk sharing and mutual support. Participants subscribe to a collective fund which known as Tabarut, from which indemnities are distributed to members experiencing covered losses. The operator functions not as a risk bearer but as a trustee or manager of the fund, adhering to frameworks such as wakalah, the agency, or mudarabah, profit sharing. Any surplus remaining after claims and expenses is shared to participants or kept for future utilization, embodying its cooperative principles. And I am done. I will be giving the stage to my classmate. Thank you.
Okay. Hello, my name is LAU Lian. I'm going to present from the X slide. Okay, example. Table 4 shows comparison of insurance and takaful companies in Malaysia. We have several categories of insurance like motor, life, family insurance, health, medical insurance, property insurance, accident and personal insurance, business and commercial insurance, and also travel insurance. For the conventional insurance, motor insurance, we have third party fire, theft, comprehensive. For motor takaful, we also have third party fire, theft, comprehensive. Motor coverage is compulsory under the Road Transport Act 1987, takaful post contribution for mutual rights sharing. For life insurance, whole life endowment, term investment link. For family takaful, we have protection, saving, investment link. Life insurance provides individual protection. Family takaful emphasizes long-term protection and saving in Sharia compliant form. For medical and health insurance, it covers hospitalization, surgical, critical illness. For the takaful one, We also cover hospitalization, surgical, critical illness. Both cover hospital bills, surgical costs, and critical illness, but Takaful ensures halal investment of contribution. For the fire insurance, householder insurance, fire Takaful is covered. Householder Takaful protects against property damage due to fire, flood, or natural disaster. For personal accident insurance include death, disability, income replacement. For personal accident Takaful and compensation in Takaful is distributed from the collective fund. Commercial insurance cover liability, marine, aviation, engineering, employers liability. For general Takaful, we have business Takaful, marine, aviation, engineering liability. Both cover corporate and industrial risks. Takaful avoid riba and GAFA in underwriting and investment. Travel insurance, we have it cover flight delay, lost baggage, medical abroad. Travel Takaful, we have the similar coverage also, but it's all Sharia compliance. Both cover delays, accidents, and emergency. Takaful ensure Sharia compliance compensation fund. Okay, Table 3 shows comparison of conventional insurance and Takaful in Malaysia. We can see the differences from different aspects: legal framework, nature of operation, compensation, ownership funds, profit, surplus, investment, principles, inclusivity, and purpose. Conventional insurance is governed by Financial Services Act 2013 (FSA), regulated by Bank Negara Malaysia. However, for Islamic insurance, governed by Islamic Financial Services Act 2013 (IFSA), supervised by Sharia Advisory Council. Nature of operation: for the conventional insurance, risk transfer, insurer assume liability once premiums are paid. For the Islamic insurance, risk sharing, participants contribute to a pool fund managed by operator. For compensation, paid from insurer owns fund strictly according to contract terms. For insurance, Islamic or Takaful, paid from the common fund. Losses are collectively borne by participants. Ownership of funds: premiums belong to insurer, surpluses retained as profit or shareholders. For the Takaful, contributions are collectively owned by participants, surpluses redistributed or retained. For profit and surplus, conventional insurance retained by insurer, shareholder, but the Takaful belongs to participant. Operator earns management fee or profit share. For the investment, conventional insurance may include interest-bearing or speculative instrument. For the Takaful, restricted to halal investment, avoid riba, gara, and mashi. Principal: indemnity, insurable interest, almost good faith contribution, subrogation. For the Takaful, tabaru, ta'awun, Sharia compliance. Inclusivity: for conventional is open to all consumer. Islamic Takaful is open to Muslim and also non-Muslim, attractive for ethical and cooperative feature. Purpose: conventional insurance, commercial protection, risk transfer, and capital formation. For takaful, financial protection with ethical solidarity aligned with Maqasid al-Sharia. Table 5 shows insurance and takaful companies in Malaysia. Type companies in Malaysia, we have conventional insurance, life general, and takaful Islamic insurance. Okay, for the conventional insurance, we have AIA, we have Great Eastern, Alliance Life Insurance, Alliance General Insurance, Ethical Insurance, Tokyo Marine, Hong Leong Assurance, Prudential Assurance, and Life Insurance, Juris General Insurance. For the takaful one, we have Syarikat Takaful Malaysia Keluarga Berhad, Syarikat Takaful Malaysia Am Berhad, Prudential BSN Takaful Berhad, Ethical Family Takaful Berhad, Ethical General Takaful Berhad, Takaful Ikhlas Family Berhad, Takaful Ikhlas General Berhad, Juris Takaful Malaysia Berhad, Great Eastern Takaful Berhad, Hong Leong MSIG Takaful Berhad, Sun Life Malaysia Takaful Berhad. In conclusion, the difference between conventional insurance and Islamic insurance is rooted in their operational mechanism as well as their philosophical and legal foundation. Traditional insurance is based on the principle of risk transfer, wherein a contractual agreement obligates the insurer to indemnify the insured or designated losses in exchange for regular premium payments. This approach is motivated by profit and function within a commercial context, frequently participating in interest-bearing investment and risk-pooling arrangements that may incorporate aspects of riba, gharar, and major components explicitly forbidden by Sharia law. Takaful is founded on the concept of mutual help, collective accountability, and voluntary contribution. The Takaful framework prioritizes solidarity and collaboration above business maximization. Participants in a takaful program contribute to a communal fund with the purpose of assisting each other at times of necessity. In contrast to traditional insurers, takaful operator functions as managers or trustee of the fund with any assets either redistributed to participants or reserved for future claims, exemplifying a non-profit system grounded in Islamic principle. Conventional insurance is regulated by secular statutory frameworks and financial laws with little regard for religious or moral compliance. The investment portfolio of traditional insurers may encompass financial items that are banned from an Islamic perspective. In contrast, takaful is overseen by Sharia Advisory Committee to guarantee that all operation and investment adhere to Islamic law. This offers takaful a distinctive ethical government framework, integrating traditional risk management methodology with religious accountability. Notwithstanding these disparities, both systems possess a unified goal to alleviate financial distress resulting from unpredictable occurrences. Traditional insurance provides a wide area of products, worldwide scalability, and technical sophistication, enhancing its accessibility in many markets. Takaful, though still developing, distinctly caters to the Muslim population, by harmonizing financial security with religious adherence. The ethical framework also appeals to non-Muslim in search of value-oriented financial product. Consequently, both systems caters to distinct market segment, requirement, and cultural anticipation. In conclusion, traditional insurance and takaful present two unique yet complementary frameworks for risk mitigation. Traditional insurance relies on business efficiency and legal certainty, whereas takaful embodies a value-driven, community-oriented alternative. Takaful distinctiveness is in its amalgamation of ethical, religious, and social aspects within financial risk management. This comparative examination underscores the necessity of aligning insurance systems with both legal standards and the ethical and cultural value of the society they aim to serve. This is some of the references of our teamwork. Okay, thank you for your attention. End of our presentation. Thank you.